Again, no surprise that the Fed decided not to cut rates, with the timing such a cut appearing to be only getting pushed further away. Let's turn to Professor Shim Myungkyu for more. Welcome back, Professor Shim.
Good morning.
As widely expected, there has been yet another rate freeze. We all saw it coming though, right?
Yes, this is not a surprise move at all, as you just pointed out. Most importantly, the inflation risk is still there, as was emphasized by the Fed. And inflation rate was about 3% recently, which is about 1 percentage point higher than the target inflation rate of the Fed, which is 2%. In addition, the geographical risk, including the Ukraine-Russian war and Israel-Hamas war, have not yet been fully resolved, and actually they are expanded to the greater area, implying that the future risk on the inflation rate is still alive. And I think this makes the Fed to hesitate to change its stance quickly, even though GDP in the first quarter was announced to be lower than expected, because the Fed's first order business is to control the price level.
Right, high inflation and also geopolitical tension over in the Middle East, and also rising labor costs are a reason for the Fed to be kind of cautious before considering the rate cuts, aren't they?
Yes, you're correct. Particularly the employment cost index in the first quarter rose by 1.2% compared to the previous period. And the index rose by 0.9% in the last quarter of 2023, implying that the labor cost is still a factor that can potentially increase the price level in the future. And the channel through which higher labor costs increase the inflation rate is called to be wage price spiral. And higher wage increases production costs, and the firm will set higher prices to make the profit. Then the workers will require even higher nominal wages to keep the purchasing power, and then the price will further increase by the firm. So as long as the labor market is tight, as we see nowadays, the Fed needs to be cautious in spurring the aggregate economy by lowering the interest rate.
Well, Professor Shim, the Fed said the rate cuts will for sure happen. That's what they said 6 weeks ago. But the question is, when will the first rate cut actually take place then?
I'm not sure, because there are so many concerns on the inflation rate. So what I think is the earliest time would be the end of this year, after the Fed collects important information on the labor market and on the aggregate economy, so that it can become more confident on the inflation rate. While there are some signs that the economy might need to cut the interest rate, like the GDP in the first quarter, but there are so many concerns on the future inflation rate, as I pointed out earlier, especially this collective tension in the Middle East and the labor cost. So as sorry.
Please go ahead.
As the chairman of the Fed pointed out, the inflation rate is still very high compared to the target rate of the Fed. And also, if the Fed cuts the rate too early, and if the inflation rate hikes again, then there will be even higher costs to lower the inflation rate further.
So it may not be as soon as June that many analysts projected. While hopes for a rate cut within the year are kind of fading away, the interest rate gap between Korea and the U.S. widened to an all-time high. I'm sure the Bank of Korea is getting anxious.
Yeah, and the critical issue here is the exchange rate that really affects the Korean economy, which heavily depends on the export. The exchange rate has increased to about 1,400 per dollar, and this implies that the Korean won has depreciated by about 7% during this year, and it has depreciated about 12% during the last 1.5 years. And given that the timing of won depreciation almost coincide with the timing that the BOK stopped raising the policy rate, the BOK will really wait for the interest rate cut and in the US so that it gives the okay to have more rooms to cut the rate.
Right. All right, Professor Shim, thank you so much, as always, for your thorough analysis. We appreciate it.
Thank you.